Hey everybody, good afternoon. This is Ryan. I am doing a little monthly client investment update here for investors and clients of Derks Financial. Good to see you guys. I'm going to keep this real short. We have 4 items we're going to go over today. Energy, let me silence that. Energy, Lululemon, Costco, and GameStop again. Before I get started, as you guys know, this is not investment advice. If you want investment advice, you need to call me. You need to be a client. This is just fun commentary. So, first things first here, a lot of our clients have a bunch of energy, and we've been talking about this for a long time. And a big development, again, Warren Buffett continues to pile in. Warren Buffett buys Occidental shares for 9 straight days, pushes his stake to nearly 29%. For about a year and a half now, Warren Buffett, the only thing he's really been buying in any noticeable amount is energy. And that I think over the last year and a half, he's really described why he's buying energy, and it has a lot to do with the same stuff that we are. The same stuff we see is that before COVID, the energy sector had been completely beaten down for years. It's very affordable. COVID happened, oil prices spiked. Exxon, Chevron, the rest. Most all of them took billions of dollars in cash that they'd never had before, paid off tons of debt, and these are extremely cheap companies that have almost nowhere to go but up, and also they are paying us a big fat dividend. So we love that. So it's nice to see. Lululemon, you guys know we've been holding on to Lulu. We had a really good run with Lulu last year. This year has not been so great. We started off the year, slightly down, nothing to be concerned about, but right here at their last earnings call, they didn't miss earnings, they didn't have bad news, they didn't have anything negative happen. They simply said, as we talked about, we just don't think the consumer is going to be that strong at the end of the year. And that, again, they should have learned from every company in the last couple of years that said that. Down 40% since then. However, they still beat earnings. They're still showing great, healthy profit margins. And this is what they said after that. So when was this? This was June 5th. So about a month ago, they had their second earnings call. And this is what they said essentially. While you were selling our stock, we've been buying it at lower prices, and when the stock tanked in late May, we started accelerating our buying. So thank you. Our board thinks we need to buy more and has more than doubled the amount we are authorized to buy. If you sell more, we'll be buying more. We did a little better than expected in the US, where we continue to see mixed signals from the consumer, but our international business saw strong momentum. We're implementing the strategy that worked so well in North America and expect to continue to see strong growth internationally. We got only 21% of our revenue outside of North America, but we expect that to grow to half of our overall business eventually. In the US, it wasn't just a weak consumer though. The consumer is selective, but they will spend. We just missed opportunities by having limited styles and limited inventories for what was working well. Even though every woman probably has a pair of our pants on right now, we still think there are a lot of people in the US who don't really know about us. So we see significant growth still ahead in the US. Furthermore, despite everything you've heard, we are still gaining market share. With our chief product officer now gone, we will accelerate the speed of new innovations so you won't even notice she's gone. We'll also have fabric we're introducing, so on and so on. Basically go to say they're going to focus on men in sports, more men athletic wear coming up. Interesting side note, which is kind of tough to really put any type of real data behind. There was a tweet that went really viral a couple of weeks back where a guy was down in LA in an outdoor shopping mall, and he had mentioned that he stopped by all the major female athletic stores, and none of them were very busy. Almost all of them had big sales. The only one with no sales and the only one with a lot of traffic was Lululemon. So not buying more at the moment, just being patient and letting those guys run the business. They've done such a good job. In fact, let me just pull this up before we get into Costco. For those of you who are looking short term and thinking, I don't know. I mean, this is a pretty awesome chart. They went public only back in 2007. So it's been 13 years-ish, 13, 14 years. They've been doing pretty good. Up right here, up 1900% in that time. So, okay, on to Costco. Costco, I don't remember if I reported this in our last video, but Costco has good news. Costco announced that they're going to hike their dividend by 14%, which is awesome for us. This is exactly what we're looking for. Strong companies that are growing, that are paying a dividend that's growing. That is awesome to see. So I won't spend much time on that. we'll go right on to GameStop. So what's happened in the last month of GameStop? Well, year to date, we're up 48%. But here, just in the last 30 days, basically flat. But I wanted to give you an update. The big guy everybody talks about, Keith Gill, Roaring Kitty, he posted this the first week of June. He said he posted what he had in GameStop. You can see here he had 5 million shares and 120,000 option contracts. And just in case anyone on CNBC or what have you is trying to sway you, he closed out all of his 120,000 option contracts, and he could have taken the money and run, but he doubled down. And now he went from 5 million shares to 9 million shares. And as far as we can tell, he still has that much. Let's see here, submitted June 13th. Yeah, as of June 13th, he still has 9 million shares. So that's awesome to see. And then also this other part that a lot of people are passing over, not realizing just how important this is. Back here in this area, you see all this crazy spikeage. As that was happening, GameStop basically, they didn't print new shares. They just sold some, they basically made some of their internal shares available to the public to raise money. And they raised, in the last 90 days, they went from $1 billion of cash on hand up to $4.2 billion of cash on hand. You guys, they have zero debt, almost $5 billion, $4.5 billion of cash on hand. They could sit there and do nothing, and they're going to be in a nice position with if you think of this in Dave Ramsey terms, they're in a really, really good spot. No debt, tons of cash in the bank. They are a profitable company, even though it's not that exciting, their profit margins and the revenue growth. In fact, they actually did report that their revenue was slightly down, slightly sideways a month and a half or so ago. So anyway, though, it is a company that now has $4.5 billion of cash on hand and no debt. Regardless of what the people on CNBC say, regardless of these swings, in my opinion, the play is still very active, still very live. All we have to do is sit here and be patient. We did sell, if you guys were watching, we did sell right there at the peak at about 44, 43 maybe dollars a share. We actually sold a chunk of profit. So we did take some profits right there at that peak. We couldn't have timed it better. Honestly, it was just perfect timing. We knew we wanted to, just perfect timing. So anyhow, that's all I've got for you guys right now. I hope life is going well. Call me, email me, and I'll be looking forward to hearing from you. And I'll make a video in about a month to give you another monthly update. See ya.